If price didn't go to take profit 6 right away. It rejected off of take profit 6 and headed smooth down. We see a smooth, retracement, from take profit 5 all the way back down to take profit 2. As you know, your psychology is everything in this market, and where you enter in this market will determine if you make a lot of money or not. This is why a lot of people lose, is because they enter the market at the wrong times. As you would have got in for trade one for a buy, and you're thinking price is heading back up, and it rejects it off of take profit 5, take profit 6 area. As you know, sometimes it won't always go to take profit 6 area. This is 843. It went right to 1841, 1842. 1843 is our take profit 6 area, and it rejected off of this level between take profit 5, take profit 6, and headed back down all the way back down to take profit 2. And you had gotten for a buy at 1839. The price shoots all the way back down, all the way down to 1821 from 1839. And you're thinking price is going to go higher, 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 and price doesn't have to do that right away. And what does it do? It shoots all the way back down to 1820. So you got in at the middle, at the top of this uptrend, where you lose the most money. This is why we draw our trend lines, and we have to pay attention. We have to be really, really patient with this market. As you become a better trader, your psychology will develop more and more. And you'll be successful over time. We had got in for an entry right here. This is how you lose the most money. And then what this price do? Shoot past all our trades and gets us out these trades. Right back down from take profit 4, all the way back down to take profit 2. This is why we draw our trend lines to get a solid confirmation. Fibonacci. We look at candlestick patterns. We see a bullish engulfing pattern, black candlestick right here. If we zoom in a little bit, see the black candlestick engulfing this yellow candlestick right here. Let us know that sellers are pushing price back down. You see black Marubozo candlesticks pushing price all the way back down to 1820 take profit 2 area, from take profit 5 all the way down to take profit 2 area. So where you enter at in this market for entries will determine if you're going to be profitable or not. As price goes against you, it heads all the way back down to 1820, from 1838 all the way down to 1820, and it blows your account. Entries, where you enter at plays a major role. As you enter at the top of this uptrend, and where you lose the most money at, you want to enter at the bottom. You would have just waited for price to retest back down, and then you could have got in for an entry. Once price retested back down, you could have got in for an entry. So we'll explain this real fast. I'll explain this move, so I can help you become more profitable in this market. You have to be very, very patient and adjust and adapt to what the market is showing you. It's extremely I know you have to be extremely patient with this market, as this move happened from February 10th to all the way down to February 11th. It took one day from February 10th all the way down to February the 11th, from take profit 5 to take profit 2, from February 10th to February 11th. It took one day for this move to happen. All these candlesticks represent 15-minute candlesticks, and it took one day for this move to happen. Over time, the more you practice, the more you trade, the better chances you'll find good entries. So as you can see, price goes against us, goes against our against this buy that we got in for. We got in for a buy, thinking price is going to go higher and higher, and price doesn't. Price goes against us and stops us out this trade, gets everybody out this trade from 1838 all the way down to 1820. So we have to wait for price to make structure, make higher highs and higher lows and higher highs and higher lows and higher highs before you would get in, for buys. And depending on your lot size, what lot sizes you're using, as that goes for entries as well. And we're going to dive in a little bit more about that. Entries, where you enter at and what lot size you use will determine how much money you'll make in this market. As price, if you had got in for like $1 lot size, a standard lot size, or like 50 cents, or even $2, and you only have like 1,000, 2,000, or 5,000 in your account, and you get in for a $2 or $1 trade, and you only got 1,000 or 3,000 or 5,000, 7,000 in your account, and you get in for a $5 lot size or a $2 lot size for an entry at take profit 5, and price heads against you and blows your account, and you're risking too much money. You're risking too much money trying to become rich overnight, being impulsive trader. I understand looking at candlestick patterns can be very boring. You see this bearish engulfing pattern right here, and there's no prices heading back down. I understand looking at candlestick patterns can be very, very boring. I understand. We see this bearish engulfing pattern. This is one of our dual candlestick patterns or double candlestick pattern. Black candlestick is on the right, is engulfing this yellow candlestick on the left. After we see this bearish engulfing pattern, going where we see black candlesticks pushing price all the way back down. And where you had gotten for an entry in your lot size that you're using, if you would have gotten for a $2 lot size, a $5 lot size, even a $1 lot size, and you only have $500 in your account, 300 in your account, and you get in for $1, $2, or 50 cents, and price goes against you and stops you out and takes all your money. Like when you could have lowered the lot size, and you're trying to risk all your money off this entry in one trade. You're trying to risk most of your money, all your money. You're risking your whole account in one trade, and price goes against you and gets you out because you're over risking. What lot sizes use. You have to use proper lot sizes, as that will also determine if you're going to become very, very profitable in this market. Like, just simply putting it, what lot size you use, like the lot sizes you use, the position size that you use, is how much money that you're risking off of each entry. So extremely important to understand. Why is this so important? Is because is you have to risk. You can't risk so much of your money as your over your, like, you're risking 80%, 90% of your capital, of your money, and this will determine if you will live to trade another day or not. As you can you can have risk only a small amount, 0.10, 0.20 lot size, and point like 5 lot size. Like, test it with a 0.1 lot size to see what direction price is going in. We're seeing price with retracing back down before heading back up, making what structure, making higher highs, and what higher lows, and what higher highs, making higher highs and higher lows and higher highs, all the way up to take profit 7. Once price got to take profit 5, made a higher high, take profit 5, and then we see a higher low, all the way back down to take profit 2 area. This is take profit 2 area right here. This over. This is take profit 2 area, and we see a higher low before we see a higher high back up to take profit 7. So extremely important, as you're risking too much of your money in Forex, and off this entry right here, you're risking too much of your money, and and you just blew your account. This is like your 5th time, your 6th time blowing your account because you're risking too much money off these wrong entries. As you got in for this entry, and price shoots right back up against you. And I'm going to show you another example of that, but I understand betting big, risking big, and sometimes you get a big reward, but not in this case. Price shoots back down and gets you out this trade. So I hope that helps, as we're going to be breaking down more videos for your entries, for your psychology. We're going to talk about entries where you could have gotten, where you make the most money at, in our next video. All right, gang, so it's your boy Nature, aka Nature. Gang.